Hello, dear algorithms traders. In today's video we want to find out how efficient breakouts really are. Every trader is always fascinated when a price moves up or down very quickly, and many have already calculated what they could have earned. It is also quick and easy money. Just press the buy button and 1 minute later you have earned 10,000 euros. Trading coaches exploit this dream by supposedly teaching you how to trade breakouts correctly. The co-coach thinks to himself that is new to the fact that he knows anything about this, but keeps his mouth shut, because ultimately these training courses will make up for the trading losses. They then teach breakout formations and other fairy tales, which lead beginners in the wrong direction out of greed. Of course, these formations worked 20 years ago, but due to algorithms and different approaches of the big players, that is unfortunately a thing of the past. The inventors were also able to earn millions of dollars with the turtle strategy. By the time the strategy was made public, the turtle strategy was over. It's the same with candlestick formations today, so save yourself the time of memorizing them. Another fake is trading breakouts after news. You should know that the market makes the news and not the other way around. You are told that the dollar will strengthen if, for example, the unemployment figures in the US are better than expected. Let's imagine that Deutsche Bank has bought the euro. If news comes out that speaks for a strong dollar, logically the euro-US dollar should go down. Instead, it goes up because Deutsche Bank wants to make the euro profitable. An entrepreneurial action is the only reason why the price moves. Many years ago, Apple had a record quarterly report, but the stock still fell, possibly because investors didn't believe it would repeat itself. Forex correlation refers to the extent to which the exchange rates of two currency pairs move in relation to each other. With positive correlation, two currency pairs tend to move in the same direction, and with negative correlation, they tend to move in the opposite direction. A reading of 0 indicates no correlation. Here we see a negative correlation, but does that really help? Because whether a price moves up or the correlating currency moves down at the same time is more counterproductive than helpful. Although correlation is a useful tool for forex trading, there are other factors to consider. Currency strength can also be helpful, but it is not a holy grail either. A slightly different view consists of two different lines that run at a 100% value. The red line shows us the dollar strength, while the green line shows the euro strength. In this case, the dollar strength is around 62% and the euro strength is around 30%. First, we draw a middle line at 50%. This shows us that above the middle line the respective currency is strong, and as soon as it moves below the middle line, it has a weak tendency. Let's look at an example. First, we can see that the dollar's strength is in the foreground. And now pay attention to how the dollar is getting weaker and the strength of the euro is increasing. The euro is getting stronger, and the price is finally moving higher. When a bullish candle is formed, there are theoretically three starting situations. The strength of the euro remains unchanged while the dollar weakens. The strength of the euro increases while the strength of the dollar remains the same. The strength of the euro increases while the strength of the dollar decreases. These three initial situations also exist with a bearish candle. While the strength of the dollar remains the same, the strength of the euro decreases. The strength of the dollar increases while the strength of the euro remains the same, and the strength of the dollar increases while the strength of the euro decreases. This situation would accelerate the downward movement more. And now let's look again at our currency strengths on the left. We see that of the 8 currencies, the dollar is the weakest, while the New Zealand dollar is the strongest. If we now look at the New Zealand dollar USD during this period, we actually see a stronger increase upwards. But I generally warn against trading the weakest currency against the strongest. The background is that at the time of entering the market you can of course never know whether the current currency correlation will continue to exist. What happens during a breakout? First, the big players are withdrawing the necessary liquidity from the market. Do you know why they do this? Quite simply because it is too dangerous for them, as it sometimes leads to uncontrolled movements. Imagine a rally world champion refusing to drive a dangerous route because it would be too risky. Would you, as a layperson, drive this route anyway? It is 3 minutes before the news, and we see an average of over 200 lots on each limit level. 2 minutes later, it is only an average of 20 lots per limit level. So the big players have withdrawn 90% of their liquidity and you still want to trade the breakout? Well, the trading coach has told you exactly what to do. There are several possibilities in the breakout. The price can immediately go up or down sharply. This would give you a 50% chance of winning. But unfortunately, trading is not a dream come true. Here we first see a fake breakout up and then the price goes down. Here we see a fake breakout downwards and then the price jumps upwards. Now the probability of winning is less than 25%. The crucial question is, how big should the stop loss be? Stop loss, what is that? That's only for weaklings. With this attitude you should get to know the Muller family. They are not doing so well at the moment because they traded without a stop loss. Let's first look at the risks of trading breakouts. We'll start with the entry. As everyone probably knows, the law of stand in the line applies to both limits and market orders. This means that whoever comes first is executed first. In the market, the price is pushed up a bit. This ensures that 100 retail traders now place a market buy order. Unfortunately, there are only 40 lots available on the limit sell side. These are executed first, then the price jumps up a bit. The next 50 lots are then executed there. And if you were the last in the queue, you will only enter the market 2 ticks later. If more retail traders enter the market, they will also be executed 2 to 6 ticks later. A breakout occurs when liquidity is withdrawn on the limit side. Now we'll play the same game again. Instead of entering the market after 2 ticks, you will now only enter the market after 5 ticks. If you enter the market later, you may not be executed until 20 ticks later. The current spread that is shown to you when you press the buy button is no guarantee that you will get into the market with this spread. If you are in the queue and are only executed later, you have to accept the spread that is then valid. It gets particularly dramatic if you enter here, are only executed at the very top, and the price then drops massively. A stop will not help you here, as there is no liquidity, and you could lose 3 times more than you were willing to invest. Another danger lurks within the price trend of a breakout. Here we see the best bid and best ask price within the first minute of a breakout. First, the price goes up. You enter here, but you are only executed here. Your stop is at 40 ticks and then the price goes down. But it is not the best ask price that is decisive but the best bid price, as the stop consists of a market sell order that runs into a limit buy order. Due to the lack of liquidity, the stop only goes off after 60 ticks, and in this case, you would have lost 50% more than you wanted. Let's move on to the breakout exit. This is where you entered, and this is where the execution took place. Due to the spread, the break-even is here and then the price jumped up. This is exactly where you want to exit and place a market sell order. Due to the lack of liquidity, the best bid price is here. Since other participants have exited with you, you are now in a queue and only exit the market here. You quickly calculate your possible profit, but the profit does not seem to be that big. In effect, it is only $40 instead of the calculated $300. You think the broker has cheated you. But the fact is that the broker had nothing to do with it. But it gets even worse. Your stop was at 25 ticks, which corresponds to a negative CRV of 0.16. So, you must win 6.25 breakouts to compensate for a single loss. That's almost impossible. This means that there are several challenges with a breakout. The problem of entry could be avoided by entering the market before the breakout. But then the question arises, in which direction is the breakout going? Is there a fake breakout beforehand? And how big should the stop be? And then it starts. First, we see a fake breakout. The price jumps up and then slowly goes down again. Look for yourself, 1 hour after a breakout, the price is very often back where it started with the breakout. In principle, only stops are triggered here and a lot of money is exchanged. Unfortunately, the challenge of the price trend during a breakout cannot be controlled. Because in court during a breakout and on the high seas, you are always in God's hands. One possible solution for an optimal exit is to exit with a limit order rather than a market order. Since the spread is very high in such a phase, you should check this accordingly. On my trading screen, you can clearly see in the fields marked how the liquidity is drastically reduced shortly before a breakout. You can also set different alarm sounds to warn you shortly before a breakout. For this purpose, I have provided you with various indicators, such as the news, and a special DOM for ADAs, with a delta volume and current volume, spoofing information, as well as the cumulative liquidity on the ask and bid side, which you can download for free from my German blog at Forex Factory. You can find more information about this in the video project Bionic Zones from the 6th minute. Now let's look at the probability of a breakout. For this purpose, I analyzed 1.2 million M1 candles from 2019 to 2024. Of course, only in the trading hours that are of interest to me from 7 a.m. to 9 p.m. Here we see the average ATR of the M1 candle in the different time periods. In the last 6 years, there have been an average of 218,000 M1 candles with this average ATR. On average, there were 200 candles per year in the Euro-US dollar that were larger than 15 pips or 30 ticks. That corresponds to a rate of 0.1%. With 200 candles larger than 15 pips, you might assume that they occur on 4 days per week. But that is a mistake, because only 458 days have there been candles larger than 15 pips. On average, there is only a small breakout twice a week. And now let's do the math. We try to trade 100 breakouts, 50 breakouts bring a loss of 20 pips and 50 breakouts bring a profit of 15 pips, of course without spread and liquidity gaps. That is a clear loss-making business. If we now include the spread, we would incur a loss of over $6,000 with one lot. Now you also know why the big players generally avoid this situation. Let's look at a solution. We remember the extreme case where a trader only earned 4 ticks in 1 minute instead of the expected 30 ticks. You can achieve these 4 ticks anyway, as the average 1-minute ATR has been 4 ticks over the last 6 years. Over 40% of all 1-minute candles reach more than 2 pips, or 4 ticks in the futures market. That's 24 candles per hour, and with the right tools you can gain a market advantage that gives you a 60% chance of winning. As soon as 4 pips are reached, you take the profit, while your stop is at 2 pips. 4 trades per day should be manageable. With this approach, you can make a profit of $6,000 per year. My developed Bionic Candle, which you can also download for free on my blog, could also help you with this. Trading breakouts is a high risk, because if you go out in a storm, you must expect to be blown away. Always ask yourself why the best traders in the world don't trade these breakouts and get out of the market for a few minutes. And so, at this moment only the retail traders are exchanging their money with each other, nothing more is happening. Get away from the mindset of making a lot of money in a short time and avoid the breakouts. If you are a professional, that is of course a completely different matter. In addition to the Forex data, use the future data to gain a deeper insight into the market. Start to be creative and try to penetrate deeper and deeper into the market with this data. You can also use the current spread to see where the market might go next. Only use the information that actually helps you. I would banish everything else from the chart. I wish you the best of luck, keep my fingers crossed for you and look forward to seeing you here again soon. Best wishes, Michael.